This chart illustrates the gap retest strategy, a price action technique used by traders to identify high-probability sell opportunities after a gap forms in the market. A gap occurs when price opens significantly lower or higher than the previous candle's close, creating a visible empty space on the chart. In this example, a bearish gap forms as the price drops sharply, leaving a supply zone above, an area where selling pressure previously dominated. After forming a new low, the price begins to move back upward, slowly filling the gap. Once the gap is filled, price reaches the retest entry area, the same supply zone where sellers had previously taken control. This area is marked as the optimal entry point for traders to enter short positions, sell trades. As the market retests this zone, traders expect sellers to re-enter, pushing prices lower once again. The green-shaded region highlights the add to position area, suggesting traders can increase their sell positions if bearish confirmation appears, like rejection candles or strong red bars. The initial target is marked lower on the chart, indicating the first profit-taking level after entering the trade. In simple terms, this strategy takes advantage of how price often revisits or retests previous imbalance zones, such as gaps, before continuing in the original direction. The concept relies on understanding market structure, supply and demand zones, and the natural tendency of markets to fill gaps before resuming their trend. When applied correctly, the gap retest strategy helps traders enter trades with high accuracy, aligning with institutional order flow and key resistance areas. This chart explains the demand activity and volume relationship in a rally-base rally price structure, a common setup used by traders to identify strong demand zones and high-probability buy entries. On the left side of the image, the schematic diagram illustrates how price first rallies upward, showing strong buying momentum. It then forms a base, where the market temporarily pauses and consolidates. This base represents the demand zone, an area where institutional buyers are accumulating orders. After this brief consolidation, the price rallies again, confirming that the demand in this zone is valid and active. The volume profile below this pattern provides crucial confirmation. During the base formation, there's typically high volume, indicating heavy buying activity by institutions or large traders. When price later returns to retest the demand zone, the retest occurs with lower volume, showing that there is no strong selling pressure. This validates the demand area. As price reacts from this zone with renewed upward momentum, traders look for an entry right after the retest, anticipating another bullish rally. On the right side, a candlestick representation shows the same concept in a real market structure. You can see a series of bullish candles forming the initial rally, followed by a small sideways movement or pullback. This is the base where the market is building the demand area. The next upward candles confirm the rally continuation. Once the market comes back down to the same demand zone, marked as entry, buyers step in again, and the price starts to rise. The volume bars beneath the chart again show high volume during the base, accumulation, and low volume during the retest, confirming that the previous buying pressure remains intact. In short, the rally-base rally-demand pattern combines price action with volume analysis to identify institutional buying zones. Traders use this setup to enter long positions at the demand zone retest, with confidence supported by the volume behavior. High volume at the base and low volume on retest signals strong demand and a likely bullish move ahead. This chart demonstrates the concept of wrong and right. Entry and buy trades using the help of divergence signals, a powerful tool in technical analysis that helps traders identify potential trend reversals and avoid false entries. On the left side, the chart highlights a wrong entry. Here, traders mistakenly enter a buy trade too early, expecting the market to rise. However, the price forms lower highs, while the indicator, such as RSI or MACD, forms higher highs. This opposite movement between price and indicator is known as a bearish divergence. It signals weakening bullish momentum and a potential downward reversal. As a result, the price soon drops after the entry, triggering the stop loss SL. This is a common mistake made by traders who ignore divergence or rely only on price candles without confirming momentum strength. On the right side, the chart shows the right entry. After the market declines and reaches a support area, the indicator starts to show bullish divergence, where the price forms lower lows but the indicator forms higher lows. This is an early signal that the selling pressure is fading and buyers are starting to gain control. When the bullish divergence aligns with a price structure reversal or confirmation candle, traders can take a buy entry with higher confidence. The stop loss is placed just below the recent swing low, and as the momentum builds, the price reaches the target zone successfully, providing a profitable trade. In summary, this chart teaches a vital trading lesson. Timing your entry with divergence confirmation is key to avoiding false signals. The bearish divergence warns you to stay out of premature buy positions, while the bullish divergence signals the right time to enter a trade. Using divergence in combination with support resistance or candlestick confirmation helps traders improve accuracy, reduce stop-loss hits, and catch strong reversal moves with better risk-to-reward ratios. This chart demonstrates 4 powerful setups for buy entries based on Quasimodo, QM patterns, and the concept of change of character, CHO-TH, both of which are essential tools in smart money trading. These setups are designed to help traders identify potential market reversals and make precise entry decisions during the transition from a bearish to a bullish structure, with the help of Fibonacci retracement levels as confirmation. The first setup is called the impulsive move, which typically forms around the 58.2% Fibonacci retracement level. In this setup, the market shows a strong downward move followed by a clear change of character, CHO-TH, where price action breaks previous highs, indicating the start of a bullish reversal. Traders look to enter near the 61.8% Fibonacci level, where demand usually appears, and place their stop loss around the 88% Fibonacci level to account for minor pullbacks. This setup often leads to a sharp and impulsive rally upward, making it ideal for early entries in a new uptrend. The second setup is known as the typical correction, forming between the 50% and 61.3% Fibonacci retracement levels. This setup represents a moderate and healthy pullback after an initial reversal signal. The price retests a higher time frame liquidity, HTF-LQ zone, confirming the shift from bearish to bullish structure with the formation of higher highs, HH. Traders can look for buy entries in this range with their stop loss near the 113% Fibonacci extension, offering a well-balanced risk-to-reward ratio. This is the most commonly observed and reliable retracement setup. The third setup is referred to as the golden zone, forming around the 75.6% Fibonacci level. It provides one of the best risk-to-reward RR opportunities because the retracement is deep enough to test strong support areas where institutional buyers are likely to place large orders. After observing a CHO-TH that signals a potential reversal, traders can look for entries near this golden level, often supported by price action confirmations like bullish engulfing candles or long wicks. Since the entry is taken closer to the low point, the stop loss can be placed tightly below the support, allowing for a larger profit potential compared to the risk taken. The fourth setup is called the deep correction, stop hunt, which involves a very deep retracement that often extends beyond the normal Fibonacci zones, sometimes reaching or surpassing 100%. This setup offers a very high reward potential, but it comes with a higher risk because it often includes a stop hunt, a situation where the market briefly breaks below support levels to trigger traders' stop losses before reversing sharply upward. Traders who identify this pattern correctly can enter at the end of this manipulation and benefit from a strong bullish reversal once institutional orders push the price back up. This chart explains the 4 types of sell zones that traders use to identify high-probability selling opportunities within market structure, specifically through supply and order flow concepts. Each type of sell zone represents a unique price behavior that reflects institutional activity, where large orders create areas of supply or distribution before a downtrend begins. Let's understand each one in detail. The first type is the supply reversal zone, which occurs at the end of an uptrend. In this setup, price moves strongly upward, forming a peak where large institutions begin selling their positions. This selling pressure creates a supply zone, leading to a sharp reversal. Traders watch for confirmation candles such as bearish engulfing or rejection wicks within this zone to enter short positions. This setup is ideal for catching trend reversals from bullish to bearish movement and often provides an excellent risk-to-reward ratio. The second type is the supply continuation zone, which forms during a downtrend. After a strong bearish move, price retraces upward but fails to break the previous high. This retracement forms a lower high and creates a new supply area, where institutions add more sell positions to continue the existing downtrend. When the price re-enters this zone and faces rejection, it signals a continuation of the bearish move. This setup is commonly used in trend-following strategies, where traders sell on pullbacks for safe and consistent entries. The third type is known as the order block zone, which is formed when price reverses from a major support area and then rallies upward before dropping again. The last bullish candle before the strong bearish move represents the bearish order block, an area where smart money placed significant sell orders. When the price returns to this order block, it often reacts strongly and resumes the downward direction. This zone combines both supply and institutional order flow, giving traders an edge in predicting market reactions. The fourth and final type is the breaker block zone, which is a more advanced concept used to identify liquidity traps and manipulation. This zone typically forms when price initially breaks above a previous high, triggering retail traders' buy stops, indicated as stops in the chart, and then quickly reverses downward. The area from which this reversal begins becomes the breaker block, a zone where institutions have used false breakouts to collect liquidity before driving price in the opposite direction. When the market revisits this breaker block, it often faces renewed selling pressure and continues the bearish trend.